This is the Value Investor Podcast with Tracey Ryniec. All things value, all the time.
Welcome back, value investors. So we're back on the hunt for value stocks, but I know some of you are maybe getting a little demoralized yet again because the growth stocks have really taken off here after Liberation Day and after the stock market hit bottoms. It's been all growth stocks since then. And many of the value stocks that we like to look at, energy, banks, big pharma, have all been lagging. And then even some of the really cheap areas we've looked at over the last 5 years, some of which have been very good performers, the home builders, the retailers, those have all still lagged what's been going on in the rest of the market. But the S&P 500 is just less than 1% away from a new all-time high now. The NASDAQ 100 has already hit a new high. And, things look pretty good over there because of the Mag 7. But I saw a quote from one of the oil analysts that I follow on X, and it was quoting a retired oil executive. And I found it interesting for the oil perspective, but also for the perspective of being a value investor, because what this oil executive is describing is exactly what all of us go through now that growth stocks are rallying again. And don't misunderstand what I'm saying about the growth stocks. I like to see them rally because I own a bunch of them, and I know you do too. Remember, just because you're a value investor doesn't mean you can't own the Magnificent Seven. In fact, I encourage value investors to have a diverse portfolio and to own a bunch of growth stocks along with their value. But it still makes us a little depressed because we are hoping to get some good deals. And there were some during Liberation Day sell-off, but as I said, many are just not rebounding the same way that the growth names are right now. But this quote from the retired oil executive kind of lays it out there about what it means to be a value investor, as I mentioned. So I'm just going to read it to you now. Okay, so it says, quote, "Yeah, it's painful holding long oil while the Magnificent Seven levitate this market near all-time highs. But physics is still a thing. So is economics. Supply is tightening. Capital is retreating and demand isn't going anywhere. You can't print barrels. It's not if this rebalances, it's when. And when it does, it's going to move fast. Until then, patience, conviction, and a strong stomach," unquote. So this was taken from, like I said, an oil analyst I follow, but it was shared by David Ramsden Wu on X. I always like to give proper attribution to people off of social media. But as I was reading this, it had some of the key words that us value investors know all too well that I've talked about on prior podcasts. And that includes the patience, the conviction, and a strong stomach. And who does this describe almost to a T, but the current greatest investor ever, Warren Buffett, who has all three of those things. Now, if you're thinking about what Buffett has been doing over the last couple of years, you have to also assume that it's been just as difficult for him to be out of most of the growth names. He does own Apple. He's reduced his position by about 50% in it, though. But he has some big positions in energy, both Berkshire Hathaway owning energy companies outright, and then also in the equity portfolio, including Occidental, which he hasn't bought for a while, even though I'm pretty sure those shares aren't going anywhere. So I'm not sure what that means. He's sitting on, over $300 billion. And then he's not even deploying it to get Occidental right at the moment. And so does that mean he thinks they're going lower? Many of us do on the oil side because of what's happening with the earnings and oil prices outside of this recent uptick because of the Iran-Israel situation, which has now retreated and had one of the worst one-day sell-offs for crude that we've seen in the last 20 years. The other bad ones were in 2022, 2020 during the pandemic. There was one bad one in 2012. I'm not sure what was the cause of that one. And then another big sell-off in 2009, I think it was or 8, it might have been 8, on obviously the Great Recession. So this recent sell-off is now in those record books, and it's not a good group to be in if you are an energy bull. So this oil executive or retired oil executive is trying to argue that supply is tightening, demand isn't going anywhere. But if you read the responses to this tweet, a lot of energy bears out there thinking WTI is going to go as low as 30, but maybe in the 40s, not this year perhaps, but maybe into next year. Who knows? That's all in the crystal ball. But there is a lot of supply sloshing around. And if the US and the rest of the global economy slows further, or the US has a recession, then the demand is really going to fall. That's when we see the oil declining. And WTI under 50 is not good for any of these companies. And so, maybe that's why Buffett is on the sidelines. He's waiting for them to get cheap, as I am. So just taking a look at what's happening with Occidental, it over the last month is when a lot of the oil stocks had some issues, but it's up about 3% in the last month. The S&P 500 is up 3.8. It has come down in the last couple of sessions on that big oil collapse. Otherwise, it was up about 10% before this recent oil retracement down. Berkshire Hathaway, by the way, over the last month has been weak. It is not busting out to new highs as we're seeing with some of these other big cap companies. And it's actually down 3.9% in the last month. It was outperforming all year. So year to date, it's still up 8%. And the S&P 500 is now up 4%. Occidental down 14.9% year to date. Looking further out even, and that's when you really feel the pain in the energy, Occidental down 32.8% in the last year, Berkshire up 18.6%, S&P 500 up 11.2%. So for those of you who have been waiting for a buying opportunity in Berkshire, if you've been patient for that, it has pulled back off of those highs. Now, I'm not saying it's cheap whatsoever, but forward PE is now at 24. I think it was about 26 at the highs. So it's a little more attractive here. PEG is still at 3.4. So that's pretty pricey on the PEG side. Berkshire still pretty pricey. We'll have to wait and see if Buffett himself is buying any more shares and what's happening with those share buybacks. But I have a feeling he's not thinking it's all that cheap here. Now, Berkshire Hathaway is mostly composed of old economy type companies outside of Apple. And those are somewhat out of favor right now. But, I'm expecting these to go a bit cheaper. So this is where the patience, conviction, and a strong stomach has to come in. And this is really what separates Warren Buffett from the rest of investors, right? Because the rest of us are all nervous. We are thinking, hey, I got to sell my value stocks. I got to get into, CrowdStrike. I got to get into ServiceNow. I got to buy Palantir. And maybe you already own some of those. But for everybody else trying to find cheap stocks and wanting to hold those, it's a little bit more challenging right now, as I mentioned. So should you buy any of these energy stocks given the huge sell-off? I would say I'm on the sidelines. I did recently add ConocoPhillips, ticker COP, to the insider trader because an insider has been buying over there on the recent pullback in these shares. But I'm not seeing a lot of other buying, and some insiders might be on the quiet period ahead of the next earnings reports, so keep that in mind. But it's not looking good for the fundamentals for a lot of these companies right now. If we look at Occidental, which is one of the larger E&Ps, and it has a big chemical division as well. We're expecting to see a decline of 36% on the earnings this year. Last year, it was down 6.5. The year before that, down 60. But that's coming off the crazy 2022, which was the Russia invasion of Ukraine, which pushed up oil prices. So that was a huge gain, and now it's been basically correcting. Analysts have a gain of 14% for 2026, but it's a little early to know what's going to be happening then. But so far, everybody thinks maybe they're going to turn it around. Now, on the PE, it's trading at 19 times. So the PEs on the energy stocks are going to remain a bit elevated because of what's going on with the earnings and the big earnings decline. And even as the shares go down, it's still not really getting like a cheap PE. It will get a cheap PE when we're back in the bull, though. But some of its other fundamentals are pretty low. Price to book is just 1.5 for Occidental. And price to sales 1.5 as well. So yeah, like these stocks, I'm on the sidelines because I don't have the patience with a lot of these. And we've been burned many times, but the bear market does seem to be here. But we're all bearish. As I said, the responses to this tweet with this executive saying, that physics is still a thing and there's still good demand fundamentals, that was attacked. So when you see stuff like that, sometimes that can mean we're near the lows, we're near the bottom of the sentiment and what's going on with that particular industry. So keep that in mind. But we've been there with the banks, right? Buffett is mostly given up on most of his banks. He's cleared most of those off the deck now, and he did it a couple of years ago. He finally threw in the towel. So even with all of his patience, he finally said, enough of this. He still does have Bank of America. Let's look at Bank of America and see what's going on there. Is that cheap? It is one of the too big to fail banks, and it's paying a dividend right now, yielding 2.2%. Forward P is 12.6, but remember, PEs aren't that big a factor with banks. Price to book is at 1.28, and that is the factor you look at with banks. So price to book, you want to buy, according to the bank analysts, at around 1 or even less, if you can get it less. But buy at 1, sell at 2. This is still on the cheap side at 1.28. So I'm liking that. And as I said, PE of 12.6. But earnings looking pretty good here in 2025. A lot of the banks have turned it around on earnings, unlike energy. And we're seeing 12.2% expected for 2025, 16.6% for 2026. So I'm liking all of that. When was the last time we saw banks put back-to-back years, double digits like that? Let's see. Year to date, how are the bank stocks doing? Bank of America outperforming the S&P 500, up 5.9%. And again, Berkshire up 8 in that period over the last month as the growth stocks have taken off. Bank of America still up 7.5. over the last month, and S&P 500 up 3.8. Its peer and competitor, JP Morgan, has been hitting new all-time highs recently, but Bank of America not quite there. I'm going to look at the 5-year and kind of see. Yeah, it's looking close on the 5-year, but 5 years just about parroting the S&P 500 now, up 102%, S&P up 101, and Berkshire up 178. And interestingly enough, Occidental now, since that big surge in 2022 in the shares, up 139% over that 5-year period. I don't think most people would have assumed that energy would still be outperforming the S&P 500, given the big sell-off in 24 and now here in 25. So energy is more cyclical. Banks have just been down on their luck for a long time. A lot of banks are number one ranks right now, especially the smaller regional banks and the community banks. Bank of America right now is Zacks number 3. It does have an F for value, an F for growth, and a C for momentum on the style scores. So the style scores aren't looking all that great for Bank of America, and F overall VGM score. So that's never good, but still got that nice earnings growth expected. And it's not that expensive. I'm not sure what else is giving it the F for value here, but the price to book is looking fairly attractive. It's not the cheapest bank I know, but it is looking fairly attractive. Will Buffett get into some more banks? That would be a story if he did, but we'll wait and see on that. As I mentioned, a couple other areas that Berkshire's in that are kind of old economy. He has some of the auto dealerships. He also owns some of the housing, the prefab housing, and all of these areas are going to be hit with tariffs and higher costs, things like that on aluminum and steel, as well as just if they're bringing in anything from overseas, they're at least paying the 10% now and maybe more. So that's maybe why Berkshire Hathaway is struggling a bit here. It is in a little more precarious position, but still you have to have what Buffett has, the patience, the conviction, and the strong stomach. You definitely need that for energy, but even for the banks, even though Bank of America is one of the few, along with JP Morgan, these too big to fail banks that are back towards their highs, the community banks are not. So I'm thinking of Bank OZK, one of the ones we've talked about on the podcast. I used to own it in the Value Investor and in my own personal portfolio. It is a residential regional bank. This one, we always have it in Industry Banks Northeast, but it's not Northeast. I would say it would be, I don't know what they would term it there because it's in Arkansas. Is that Southeast? I think maybe I might put it in the Southeast. It's paying a dividend right now of 3.7%, but the shares have moved sideways for years and years. And just when you think, hey, it might break out of this narrow range, it doesn't. And it just kind of breaks down, but not like a huge sell-off kind of breaking down. But Bank OZK, I'm just looking at the 5-year, it's still up 111%. It had a big surge during the COVID during 2020, which is still keeping it kind of elevated. Over the last year, though, no, it's still up in the last year too, but it's still trading in this range over the last year, but up 20%. Which is better than even Berkshire Hathaway, up 18.7%, and the S&P 500 up 11.3%. And you really have to have patience with it, though, because it looks like it's about to break out, and then it doesn't. And then it goes back into that narrow range over the last 4 years. Again, you will get this nice dividend yielding 3.7%. It's never been a real dividend paying stock, but it is generating some very nice cash right now. So these regional banks are being kind of thrown out, and they are cheap. And so they don't know what else to do with it. They are paying it out. Now, price to book for Bank OZK is at 0.96. And remember, you buy at 1, sell at 2. So it's just below 1. So very cheap here. PE, even though it doesn't really matter as much for banks, 7.6 times. So that's really cheap. And what's going to happen with the earnings? Well, this year still expected to be down 3.3%. But next year, 2026, up 11.1. And this bank is in on the real estate side of things. This is why the stock is not really breaking out. People thought it would get into trouble with the commercial real estate, which it does have some. But what it does is a development bank, and it loans for you to go develop the building, and then it's paid back. So it's not going to hold on to that office building for 10 years. It's mostly just a few years on the loans, but it doesn't mean they haven't had some that haven't worked out, but that's very low. They have very good underwriting. They also been lending on the apartment buildings going up everywhere. That has some people nervous too, because it does look like there might be oversupply in some areas. But again, usually the building it's sold or refinanced so that they can pay off those loans back to Bank OZK. So I still like it for its real estate portfolio. Great management, as I said, but this is another one where even though it's cheap, you have to have the patience, the conviction, and certainly a strong stomach, because it was pretty wild on Liberation Day sell-off, and it has come back, but it's not back to those highs yet, which is over $50. So 52-week highs at 53.64, and it is trading at 46.51 right now. So keep that in mind. But I'm still liking, again, these regional banks. Maybe I need to get back into it in the value investor here at Zacks. But we've been waiting a long time for any kind of breakout here, and eventually we will get it. But this is why value investing is so difficult, because you really have to have that patience part of it. Buffett does. He's willing to wait years, decades even, in order for something that's cheap to break out. And just an added aside, I do find that it's easier to hold on as long as you are getting some kind of dividend, even if it's small, because then at least you're like, I'm not getting nothing. And you can reinvest the dividend and get a few more shares, hopefully at the cheap levels as well. So the dividends can be good motivators to keep you in some of these stocks. And all the ones I've mentioned, except for Berkshire Hathaway, paid dividends. Bank of America, ConocoPhillips, does Occidental? I think they didn't used to. They were maybe buying back shares or something. Let me see if Occidental is paying one again. Yes, it looks like they are 2.3% dividend with Occidental. So it is a smaller dividend, but now that the stock is sold off so much, you are actually getting a little bit better yield now. And then I mentioned Conoco's was a little bit better at 3.5 now because of the weakness in the stock. So that's almost similar to Bank OZK. And then Bank of America is in the 2s. Some of the regional banks I've discovered are paying, 3 to 5% yields now, because everybody's kind of throwing them to the side. So I know I keep promising I'm going to do an episode on the banks, and I think I'm going to wait until after the next earnings season, because it's fast approaching. They're always the first to report in that first couple of weeks, and we're going to get even further updates. But right now, there are a lot of Zacks #1 ranked stocks in the banking sector. So it is you can't even really just screen for Zacks number one ranked stocks and hope like, oh, this will cut it down, because there are so many that are in it. Let me look real quick. So we have many different categories. We have banks foreign, and wow, this has got to be among the biggest number of banks foreign I've ever seen on the Zacks number one list. And there's currently 223 stocks on the number one list. And just scrolling down, I'm seeing 6, 12, at least 12, maybe 15, no, 20 stocks at least on banks foreign. And what does that mean? That means these are the big banks you find in other countries, obviously, like Banco de Chile, that's on here, ticker BCH. Deutsche Bank is on here again, ticker DB. Swedbank, SWED Bank, and the ticker is SWDBY on that one. There's just a bunch. Commonwealth Bank of Australia. I don't think I've ever seen that one on a list like this. Ticker CMWAY. C as in Charles, M as in Mary, W, A as in Adam, Y. Why? That's a good question. I'm looking at it now because I've not seen this on the list. It's a $205 billion bank. Dividend is yielding 2.3%. Earnings for 2025 expected to be up 7.8 and 2026 2.5. Has the forward PE of 30, so that's pretty high. But again, we don't care so much about PE. What's the price to book is still 4.1. So this is an expensive bank over in Australia, but they do everything. They do, investment, business banking, credit cards. They're doing everything at 200 billion market cap. So, I encourage people, check out the number one ranks on the banks. And I will be doing a show on it coming soon because we all want to know more about what is so good in this area right now. Why are the analysts all so bullish? The market is so bearish. And how can we as value investors, maybe get into this trade? Some of these, though, have had quite a run, I've noticed, because foreign stocks are in right now. And that means even the banks, and that's where a lot of money is piling in. So on the Commonwealth Bank of Australia, year to date, shares are up 29.8%. So you're not, other people are in this party, but for the most part, it's not really us mom and pop investors, right? It's mostly probably institutions. Over the last year, it's up 45%. And a lot is in the last month. Let's see what's happening in the last month. Up 9%. S&P 500 up 3.8. So that's Commonwealth Bank of Australia, ticker CMWAY. So we're always discovering new and interesting value stocks. They might not be in the areas you want them to be in. I wish I could tell you something differently about the tech stocks and growth stocks. There's an occasional cheap one in there that I'm able to find. Sometimes it's on fintech side, but things are getting a little pricier again on the growth stock names, which includes most of tech. So, but we're always here to find them, and I aim to do so. But what is Warren Buffett doing with his 300 plus billion? He's waiting. He's having patience. He has conviction. He has the strong stomach. And so should we, right? Let me recap the stocks we talked about. So there is Berkshire Hathaway, BRK.B is that ticker. It has come off the highs, but it's still not that cheap at 24 times. But you can buy some of similar components that he owns or buy what he owns. Bank of America, it's cheap, but not dirt cheap. Ticker BAC, B as in boy, AC. We talked about ConocoPhillips, ticker COP, which I own in the Insider Trader, and Occidental, which Berkshire Hathaway owns a big chunk of now. Ticker OXY is that ticker. We talked about other banks, Bank of the Ozarks, ticker OZK. Well, it's just Bank OZK now. I'm calling it the old name. It did used to be called Bank of the Ozarks, but that wasn't trendy enough. They want just Bank OZK now, and it's OZK. So that's easy. And then we just threw in Commonwealth Bank of Australia here at the end, ticker CMWAY. Trades over the counter as many foreign companies do. CMWAY is that ticker. So as always, I aim to bring you as many value stocks as I can find. And we're doing so every week. So make sure you are subscribing because we are coming up to earnings season. A lot is going to go on and there's going to be a lot of changes in the rank. There will be some value stocks that surprise in there and we will find them. So get us on Apple, get us on Spotify, get us on Amazon Music. We're on SoundCloud. We're on YouTube on the podcast channel. Go to Zacks Podcast and subscribe over there to never miss our podcasts. But get us somewhere and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.